When we reflect back on the last 20, 30, 40 years and the developments that led to the GFC, it was essentially a significant build-up in debt across the globe. Of course, since the GFC, we've had ultra-easy monetary policy, both conventional, in other words, cash rates, low cash rates, as well as unconventional quantitative easing applied to a whole range of economies. And we reached an inflection point about 3 years ago when that ultra-easy monetary policy was no longer necessary and gradually needed to be removed. Now, of course, that's not the same across all economies, and the US is at the forefront of that. But if we reflect back on what occurred during that period, the ultra-easy monetary policy did elevate asset prices in a whole range of areas: equities, property, infrastructure valuation, and in the case of fixed interest, credit valuation and high yield credit in particular. So of course the Fed was on this gradual path, and we've been on this view that the Fed and other central banks over the next 5 to 10 years will gradually remove some of that ultra-easy monetary policy. They've been on this path to normalising, and of course we got to a period late last year where that was just a bit too much for markets, especially around valuations, and the feedback loop was a softening in equity prices, a softening in property prices, and a softening in investment grade credit and high yield markets. So the Fed's paused essentially for this year, and our expectation is that over the next few years that will gradually resume. Now, we've always said that this normalising of cash rates and monetary policy, whether it's conventional or unconventional, is going to have a few hiccups along the way, a few false starts. And I think 2019 is very much one of those false starts. Our expectation is that once we get past this mid-cycle pause in the global economy led by the US, we'll be able to get back to some sort of normalising in cash rates. I think it is important to frame this in the context of where normal cash rates are around the world. And we will say, because of the build-up in debt, that normal cash rates going forward will be materially lower than they were in the past. So when we think about central bank policy, and let's talk about the US for a moment, we think that neutral cash rates is around 2.5 for the US, so quite a lot lower than it was pre-GFC. And in economies like Australia, it may even be a little bit lower than that, maybe in the low 2s. So we're not talking about a very threatening environment in terms of significant rate rises around the world. Now, of course, bond yields can overshoot to the upside, just like they'd overshoot to the downside. So our focus is more around managing that interest rate risk when bond markets overshoot, with bond yields now at 100-year lows again.